Just want to let everybody know that Brian Chung and Julia LaRoche are now with us as well, because we're inviting into the program Sean Darby. He is Jefferies Global Equity Strategist, and we're going to look at what we can expect with the markets, especially the market rally underway today, as we go into earnings season. Second quarter is expected to be down. But Sean, welcome to the program. There are going to be some areas that seem to do well, and you remain modestly bullish on the banks despite the potential losses with their credit portfolios. Why do you remain bullish on banks?
Well, we think we're over the worst of the credit cycle. So credit spreads in the United States, particularly for investment grade, have come down really from their March 23rd highs, and that's generally good news for banks because it shows an easing in credit conditions. So that's one thing. Secondly, we're also seeing that the dollar's weakening. So that's a big monetary easing for both the United States and the rest of the world. So that's generally good for credit conditions overall. And thirdly, we've just come out of the stress test by the Federal Reserve, and the fact that the banks were able to keep their dividends intact was also, I think, a sign that perhaps we've sort of got over the worst of the bulk of the impairment charges. So psychologically, I think we've come through the worst of the credit cycle, and that really means the banks should be on some sort of sure footing going into the third quarter. Thank you.
Sean, it's Julie here. Broadening it out from the banks, and given that we've just finished the second quarter, as we get into earnings reporting season, what kind of volatility do you expect in the markets? Because even if things are improving and investors are going to look past the second quarter to outlooks, it's still very difficult to sort of estimate what earnings are going to be. So I would imagine there's going to be some confusion and perhaps some volatility as a result of all of that.
I would agree. I think the one thing that we're certainly seeing with the broad economic data is that it's not only surprising on the upside, but also that it's going from modestly bad to pretty good. And that means that you could have some pretty big surprises for parts of the S&P. And bear in mind that nearly 35% of the revenues come from overseas, which places like Europe and Asia have actually shown some really demonstrably pretty good economic data. You could actually see some reasonably healthy earnings reports. But that brings about perhaps worries that we may have got a little bit ahead of ourselves. And again, markets will be trying to anticipate, whether there's enough, inertia within the political arena for extending a lot of the furloughing and also the measures to support wages in the US. So there's a nice, the fiscal balance that's got to be taken into consideration when we get these good reports, is that not everyone is seeing the benefits of the recovery that the S&P companies may be showing. Thank you.
Hey, Sean, it's Julia LaRoche. It's great to be with you, even though we're all virtual now. You were just talking about your dollar outlook, weakening dollar. I was hoping you could elaborate more on that and what the implications could be for the U.S. stock market and even the global markets as well, since I know you look at it from a global perspective.
Yeah, it's a really good question. So of all the measures that generally signals a bottom in equity markets for the US and also a bottom in earnings, the power of the US dollar is probably one of the most important. And really the fact that the trade-weighted dollar has dropped around about 7% from its peak in March means that we've had an enormous monetary easing outside of what the Federal Reserve is doing. To put that into context, a 1% drop in the broad trade-weighted dollar generally means an uptick in global trade by about 0.75%. So that's really important for the emerging markets. So what you've seen over the last 2 months is actually a huge relaxation of monetary policy for emerging markets, which are very, very important in terms of the overall growth environment. At the margin, they create more than 60% of marginal GDP growth today. So that's a really big added bonus for the global economy coming into the second half of the year. So yes, behind the scenes, the dollar move has perhaps been a massive stealth easing. Thank you.
Hey, it's Brian Chung here. I wanted to loop back to the subject of the financials. So what's interesting is that there is still amount of considerable uncertainty because even though the Federal Reserve, for example, has capped the amount of dividends that the large banks can pay out and suspended share buybacks, that's just for the third quarter. And the Fed said it could continue to impose those caps and those restrictions if it deemed it necessary to retain capital. Does that also weigh into your outlook for the U.S. financials? And would you expect that if there were to be a considerable downturn in even the path of the virus, that your thesis on the financials being modestly bullish might change?
That's a good question. I guess the way I would look at it at the moment is the Federal Reserve has been extremely prudent, and the memories of the 2008-09 GFC are still very much uppermost in people's minds. I think the way I would approach things is that, first of all, inflation expectations in the United States have been picking up. So the worst case scenario for the banks would be outright deflation. Secondly, household balance sheets are in extremely good shape. So we came into the GFC with household balance sheets possibly being almost best in the last 30 years. I think the third thing to highlight is that real interest rates in the US are negative, and they're going to remain negative for quite a considerable time. So in a way, the banks have got an insurance policy because all those deposits sitting in the system are actually earning depositors really very little, and actually the banks have got an assured base of capital. So there's no real, I feel, any distress really for the banks. We're over the worst in the credit cycle. And again, my sense is that the biggest worry of asset deflation is largely behind us now. Thank you.
Sean, as we wrap up, I've just got to ask you, you're there in Hong Kong. What, from your perspective, if anything, is changed since the new national security law went into effect, especially as you look at the financial services industry and its concentration in Hong Kong? Is that going to change over the next few years because of the new status for Hong Kong?
That's a very good question. And I think in many ways, of course, things have changed. We can't deny it. I think the way the economy operates, I don't think it really makes much difference. Hong Kong is an open capital account, so money can move quite freely. It's a conduit for Chinese companies to raise money, both domestically and also overseas. And thirdly, my sense also is that, again, Hong Kong's been hit by not only political pressures, it's also been hurt by COVID-19. And the type of economic rebound that you get when you've had, a double dip recession, as Hong Kong's experienced, tend to be quite strong. So again, when you see those indices today in Hong Kong and China, a lot of it is reflecting the poor outlook we had for global trade last year, political tensions between US and China, and of course coming out of COVID-19. So again, economic rebounds tend to be quite strong, and that's really sort of overshadowed perhaps some of the worries about the introduction of the national security law in Hong Kong. Thank you.
No, thank you, Sean Darby, Jefferies Global Equity Strategist. We appreciate your insight here on The Move.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.